lending. I'm really here just to give you the no BS education on what is the qualified mortgage, what are the new rules and regulations that are coming out, why is it important for you, and will you still have a job come January 10? Obviously the answer to that is yes. The landscape that we operate in is going to look a little bit differently, that's for sure, but we're still going to be fine. So before I really get started, I always have to throw this out there. The views and opinions expressed here today are that of John Hudson and only John Hudson, and not that of NAB, the Association of Mortgage Professionals, or that of Premier Nationwide Lending. I always have to throw that out there because I have a tendency to throw out a hot sports opinion every once in a while. I was on a panel in New Mexico back in November, just a week before the election, and I gave some political opinions and forgot that I was sitting next to the Assistant Attorney General for the state of New Mexico, and she happened to be of a different party affiliation and reminded me of that. So I always make sure I throw out the disclosure so that way nothing can come back on my company or also the other organization I represent. Who am I? Where did we come from? NAB. First of all, how many NAB members do I have out there in the audience? A handful. All right, the rest of you guys, I'm going to hunt down and I'm going to make you join. NAB is the Association of Mortgage Professionals. Started out in 1973 as the Mortgage Brokers Association, and as our industry has evolved, so has NAB. It's because the issues that we have here today are not broker issues. Quite frankly, they're not banker issues. These are consumer issues. And a lot of the things that we're fighting on, the new rules and regulations that are coming out, really do impact you, the originator, and that is what our organization focuses on. As opposed to where you have MBA, who's really out there, fighting regulation and legislation on a company side, we're doing it on more of the loan originator side. So we are a true non-for-profit, and we are out there for the small business, consumer protection, and really helping the originator. And then who am I? I'm John Hudson, the former Government Affairs Chair for NAB. Currently I'm the Communications Chair, but I think they just keep giving me different titles because they've got me locked in under indentured servitude. But I am still heavily involved in the government affairs side of things. I've testified before Congress on these issues, the qualified mortgage and Dodd-Frank. I've written many articles and for congressional research reports. I have been heavily involved with really writing some of the legislation that's been out there that's been proposed. I think the latest one that we all saw was H.R. 1077. I helped write the language for that. So I guess you could say I'm a little bit of an expert. Again, I'm here to give you the no BS opinion. This isn't just a commercial. This is really important for everybody to know. And I'm passionate about this, particularly these topics, because ultimately I do care about our industry. I care about our profession. I was speaking in New Jersey a couple months ago, and I had a loan officer come up and ask me why are all these things happening because of Dodd-Frank? And it blew my mind. I'm like, who is Todd? I don't know Todd. But the sad part is, this guy was a loan officer. No idea. Dodd-Frank, CFPB. I've asked people, who here knows what the CFPB stands for? About half the room in New Mexico knew what CFPB stood for. And I'm just like, guys, if your eyes aren't open down, then the odds are you probably won't be able to make it in January, just because you won't be able to keep up. So there's been a lot of information that's been out there regarding the qualified mortgage and the new regulations. Not a lot of webinars, and a lot of them tend to be geared towards certain agendas. And I will tell you that today, this isn't a recruitment pitch. Of course, I'd love it if you all worked for me. Sorry, shameless plug. This isn't a wholesale pitch. Again, we'd love it if you brokered every single loan to us. This is more important for you as an originator to know these things, to know what our landscape is going to look like in January. The better that you guys are as professionals of your industry, the less that the regulators will be coming to enforce and write new rules on us. So, with that, where do we go from here? This is honestly probably the best illustration of what I can tell you it's like up there in Washington, D.C. You really have to be able to navigate through all kinds of mess. That's probably the best safe word that I could use because I'm being recorded right now. It's frustrating to a certain degree because if I'm working with Republicans on a bill that's going to help us on the mortgage side put consumers into homes, odds are it's the Democrats aren't going to like it. If I'm working with Democrats on a bill that's going to help put consumers in the loan and help us in the mortgage industry, the odds are the Republicans aren't going to like it. And I think we got a perfect illustration of this little road sign here last month with this the 3-week government shutdown or paid vacation. I mean, I had borrowers that were essentially homeless for a number of days because of the government shutdown and the impact on the USDA. Managed to get one of our families on CNBC because they called our broker, and the broker called me, called our rep called me, and we got them on CNBC to tell their story. But it was a real story. These were real consumers that were being impacted because of the shenanigans that are taking place up there. So I don't care what party affiliation you're with, I'll work with both sides. My goal is to help put consumers into home loans, help them achieve what we do. Put people in the homes, give them finance that American dream. So is everyone ready to learn a little bit more about Dodd-Frank? Good. So really, there's a lot of misconception about the structure of the CFPB. I hear people saying that, man, they don't have to, they don't have any budget, they don't have any, they can do whatever they want. And to a certain degree, that is a little bit true. I commonly, lovingly refer to them as the Dodd-Frankenstein, because they really are the mother of all agencies. Or I lovingly refer to them also as our new fourth branch of government. We have the legislative, executive, judicial, and now also the bureaucratic. And I say that because they literally have the ability to promulgate, regulate, and enforce rules and regulations on just about every financial decision that you or your customers will make out there. Whether it's pumping gas and using their ATM debit card, whether it's transferring money to a child in college, ultimately is it putting money in their 401k, is it ultimately buying a house. They have the authority to write rules and regulations on that. And what's interesting about their structure is I'm sure everybody heard a little bit about the controversy surrounding the recess appointment of Director Cordray. Well, yeah, it was controversial until the Senate confirmed him, and well, so now they're official. But I think it should be pointed out that there is a group of congressmen that really want to change the structure of the CFPB, and it should be because, quite honestly, an agency that has this much power and authority probably shouldn't be under the purview of one person, one political appointee, one agency that really doesn't have to answer to Congress, doesn't really have to have a budget. They draw from the Treasury. So when the government was shut down, they were still in business. When Director Cordray goes and testifies in front of Congress, he kind of does it more on a formality. Technically, he doesn't have to because they're not under House appropriations. So I would urge you that when a bill comes out supporting the change in the CFPB, that you do get involved, you do pick up the phone, and you do call your congressman and let them know your thoughts of, well, why the structure of the Consumer Financial Protection Bureau should change. Now, with that, they have a broad consumer protection mandate. Who can argue with that? We all want the consumers to be protected, right? Well, there's a difference between protection, and then there's also a difference between hindering consumers' ability to obtain financing. So the director went on record in a testimony and said, a vibrant economy does require a vibrant housing market. Well, in order to do that, they said it needs three things: transparency, free market, fair competition. Again, who can argue with these things? But then it's little comments like this that frighten me as a mortgage professional when I see it. And that is, the head of the CFPB said Friday, the only way to create meaningful change in the mortgage market is for citizens to unite with federal agencies, state officials, and local partners. So what does that tell you? It tells me that it's trying to generate this gotcha mentality between consumer and creditor. It's trying to create this adversarial relationship when right now more than ever, consumers need to be working hand in hand with their creditor. We don't need this adversarial relationship. I commonly say that obtaining a mortgage today is like visiting your proctologist. Except the difference is we're going to put you on a birthday card distribution. You know, to a certain degree, it's true. I mean, we want to see up in everything that a borrower has to do in their financial life. So anyways, a couple other things with the structure of the CFPB. I'm sure that everyone heard about Raj Dante. He was the number 2 at the CFPB, very smart guy. Had several meetings with the guy. I mean, he's smart. I mean, he knows exactly what he's doing. And I'll remember about a year and a half ago, we had a meeting with him. And we were about 45 minutes into our hour. He kind of leaned back in his chair. Then I was there talking about mortgage broker issues at the time. And he goes, you know, there sure are a lot of you guys. And at the time we walked out of there going, man, what does that mean? Does that mean he wants to just get rid of mortgage brokers and get rid of all of us? What does that mean? Well, then we found out in January that he left to go be with family, and a couple months later popped up on the radar screen promoting his new company, Fenway Summer, which is going to act as a wholesaler for non-qualified mortgage loans. So he said, hey, I know there's a business opportunity out there. And, well, I think he found it. But again, it's one of those problems is when you look at their management page for this new company, you'll see that all the heads of management are former CFPB officials. I think that's just another testimony to what's wrong with our government and the revolving door between, hey, the guys that made all the rules and wrote them are now going to go profit from them. Some CFPB hot points before I get too much into the qualified mortgage. These are just some things that I think people really need to be paying attention to from a compliance standpoint. Sham joint ventures and marketing services agreements. Does anyone here that originates have worked within an MSA or a joint JV? Double check your paperwork and make sure that it is compliant to the T. Because I will tell you that they are coming in and they are looking and analyzing every one of those. What's interesting to note about this Paul Taylor Homes case that was up here in Dallas is Paul Taylor was a builder. They slapped him around. They slapped the builder with a $118,000 fine because he was part of a sham joint venture. And now what these guys were doing at Paul Taylor Homes was blatantly against the rules. I mean, they had a mortgage company that really didn't have employees, that really didn't advertise to the public, and there was money moving around. I mean, it was blatantly violating RESPA rules. But what's interesting to note, though, is the CFPB got wind of it through an FDIC bank audit of the builder. FDIC was just auditing the bank and saw something that looked funny. They didn't know what it was. They called the CFPB. So why is that important for you guys to know? Because y'all need to know and be aware of the fact that the CFPB has memorandums of understanding with just about every other regulatory agency that's out there. And they are on, with these MOUs, they're basically instructed that, hey, if you see something that's mortgage related that just looks a little bit funny, go ahead and send it over our way and let us take a look. And that's what happened in this case. There's another case that just popped up on the radar screen a couple weeks ago, and they announced in Kentucky that they're going after a joint venture out there. Now, in this case, you have a real estate company, a mortgage company, and a settlement agent, an attorney out there, basically working in kickbacks and like marketing agreements and stuff like that. Well, the settlement attorney claims that they're doing everything right. CFPB says, we don't care. It looks funny, it smells funny, where there's smoke, there's fire. So here's what we're doing. We're imposing civil action on you guys for violating RESPA rules and kickbacks. So if you do have an MSA, I strongly advise you go back, look at your paperwork. You cannot have enough documentation sorted with that. If you want to ask me questions later about that, I can refer you to some guys that might be able to help with that. Misleading advertisements. We've all seen the advertisements of stop paying more in rent, right? Well, guess what? That's misleading. Why is that misleading? Because you can't guarantee that a consumer's rent is going to be less than what their mortgage payment will be. You can't guarantee that. So if you change your advertisement to stop, are you paying more in rent than you would if you bought a house? Well, in that case, you're asking in the form of a question, and now you're not misleading. So I know that seems like minutia. It is, but these are things that you need to be aware of. If the village idiot in the Dallas-Fort Worth area can be any way misled or confused by your advertisement, then it is misleading and deceptive, and you're going to be getting a phone call. And trust me, you don't want a phone call from anybody that has bureau on their business card. The other thing too is UDAP. We should all know. We all know what unfair, deceptive acts and practices are. Well, now we have unfair, deceptive, and abusive acts and practices. The problem is nobody knows what the true definition of abusive is. Director Cordray in some Senate testimony last year said, when asked what abusive was, he said, I'll know it when I see it. Well, what does that mean? I mean, how am I supposed to operate within the confines of making sure that I'm compliant and taking care of my customer when I don't even know what the rules of the game are? Compliance controls. You guys need to be making sure that every person in your organization is aware of your compliance policy and manuals, everything from fair treatment to your red flag acts, to your SAFE Act, and everything. Everybody that works for you needs to know what your complaint policy is. And when they come in and they examine, and it's not a matter of if, but when, they will be asking random people in your company, hey, do you know what the privacy policy is? Do you know what the complaint policy is? That's the way they work. So it's important for everybody in your organization to know these things. Vendor oversight. If you're a creditor, you need to make sure that you have a vendor management compliance system in place. And that is any third-party vendor that you use, whether it's an appraisal management company, credit reporting agency, from a wholesale side of things, my mortgage brokers are third-party vendors. We're going to have to implement a compliance management oversight system for our brokers. So these are the things that's coming. Has everyone heard of the term disparate impact? If you haven't, I highly suggest you Google it. I'll get a little bit more into that because it's extremely important that you understand what disparate impact is. Basically, you could be found guilty of discriminating even though you don't have any intention of discrimination. That's the short gist of it. And then complaints, the consumer database is pretty interesting if you haven't been in there and looked at it. So, ATR, the ability to repay, the qualified mortgage. This is what you guys came for, right? What is ability to repay? What is the qualified mortgage? Well, basically, when Dodd-Frank was written, and yes, a side commentary here, I think it's pretty sad that we as an industry needed a law to be written to say that we need to make sure that a borrower can pay me back before I lend them money. But that's what we have here with ability to repay. So no matter what, Dodd-Frank says that any home loan that I give, I need to make sure that the consumer has the ability to repay my mortgage loan. Otherwise, I'm going to be subject to legal challenge. I've got little legal risk associated with it. So with the determining ability to repay, Dodd-Frank set out to do three things. Eliminate risky products, which, hey, we got rid of the fog and mirror loan program. Stated income, no doc, those are gone. It set criteria for income and asset documentation, so now I have regulations telling me how to underwrite home loans. And then it's got this little pesky 3% cap on points and fees, which sounds great and all because, hey, when they give out the press release, they talk about how we don't want consumers to be paying excessive upfront points and fees. Well, shoot, neither do I. But the problem is you start getting into the fine print on what is the definition of a point and fee, and then you'll be able to see where it becomes problematic. So, why do I want to originate qualified mortgages? Well, if I have to determine ability to repay on everything, what is the best way for me to mitigate my legal risk associated with a possible challenge? Well, I'm going to go out there and I'm going to originate a qualified mortgage, which gives me kind of a legal safe harbor. It lets me go that, hey, this is my checklist. These are all the things that I did. I fit in the box of a qualified mortgage, and therefore it's pretty much presumed that I made sure that I measured a consumer's ability to repay. Because if that borrower challenges me under ATR and they win, then not only am I subject to civil penalty, which could be anything from forgiving a note to punitive damages. Here comes that abusive word again. There's statutory penalty in there. Which, it says 3 years worth of interest, which on a $200,000 loan at 4% is what, $23,000. Here's my favorite one. We have all seen have you been injured at work? Have you been in an auto accident? Well, guess what? If they sue me and they win, I have to pay plaintiff's attorney's cost. I know that there was a collective cheer from the American Bar Association, the American Trial Lawyers Association, when this was thrown in there. So I could just see the lineup now of billboards saying, did your lender really make sure you could pay back that loan? So, and then let alone the cost for me to defend an ATR challenge is exorbitant. If you ask any of the big five attorney firms, whether it's the Wiener Bronskis, the Ballard Spars, the Buckley Sandlers, the K&L Gates, if you ask any of these guys, they'll tell you right off the bat, you're looking at probably $50,000 a pop to defend an ability to repay challenge with these law firms. And by the way, you're going to want these law firms doing it because they specialize in this stuff. And if you actually have to go to court and litigate, you're looking at the $75,000 range. And mind you, these aren't going to be class action suits. They can't be because these are individualized loans. So the cost associated with not originating a qualified mortgage and the possible ability to repay challenge is far exceeds the risk associated with it. There's not much reward there. And while there might be a 3-year statute for them to just say they want to challenge, there is no statute of limitation in a defensive foreclosure. So in the hypothetical realm, because of course we don't know exactly what it's going to look like when the big red button is pushed, so we're all building and developing strategy for the hypothetical here. Well, hypothetically, what's going to happen in year 29 of a 30-year mortgage when that borrower quits making their payments? I'm going to go try and foreclose, right? So the borrower's going to say, well, I don't want you to foreclose on me yet. I'm going to challenge your ability to repay. And now I'm going to have to show up in court and dig up the 500-page file and show up and say, look, here's where we originated a qualified mortgage. Or here's where we did an ATR. But bottom line is that borrower's going to be able to fend off my foreclosure for a number, for who knows how long, by challenging that whether or not I measured ability to repay. So even though I might win, it did what? Succeeded in pushing off how quickly I could foreclose on, and it also increased my cost. Which ultimately, who's going to pay for all these attorney bills? The rest of us, the consumers. Shoot, if the Dodd-Frank, except the Consumer Protection Act, it should have been known as the Permanent Jobs Act for attorneys. Shoot, the big 5 banks spent over $100 billion in the last 12 months in attorney's fees. And we're not even in January yet. So just imagine what it's going to look like there. So there's other reasons too why I'm only going to want to originate qualified mortgages on the outset. I mean, I have the signee liability. You know, am I going to have investors to sell loans to in the secondary market for non-qualified mortgage loans? Well, I know Raj Dante's company is going to be there, but who else? And we don't even know what his structure is going to be like. Is it going to be a scratch and dent market? Who knows? On top of that, you've also got the problem of, okay, are the regulators going to be coming in and making sure that you're originating QMs? So that way they can put a big red flag in every non-QM and let that borrower know that they've got the ability to challenge you. Also, there is no cure for a qualified mortgage error. Once you tiptoe outside the QM box, you are forever outside the QM box. There is no principal reduction. There's no giving money back to a borrower. You are in forever non-qualified mortgage. So, again, what is the qualified mortgage? Well, it's my kind of legal safe harbor that's saying that, hey, I filled out the checkbox here. I went ahead and presumably measured that the borrower has the ability to repay. So, what loans are covered? Well, basically every first and second lien, primary, second home, any loan, closed-end loan that has the purpose that's for securing the property, that is going to be qualified or fall under the purview of a qualified mortgage. What's not covered, interestingly enough, is HELOCs, timeshares, reverse mortgages. Boy, there's a product that needs a little restructuring. Commercial loans, interim construction loans. What's interesting about commercial, what is commercial? Non-owner occupied, right? So while yes, technically it's true that me as a lender, I don't have to measure ATR on a non-occupied property, on an investor loan. Does that mean that I'm going to underwrite outside the QM box for a non-owner occupied? No. Because my cost of compliance is already so high. Why am I going to deviate from the system that I've got to do on 95% of my mortgages just for this special one? And I don't see any other lender, and I talk to other folks in the industry too, and no one's really going to treat a non-owner occupied property any different. Plus, what if the borrower moves in? Are they going to be able to come in and say that, well, you really knew that I was going to occupy that property? I can see a borrower doing that. We see it all the time. So just be aware that although technically investment property loans don't fall under this purview, most investors are still going to come back and they're going to underwrite to a qualified mortgage for this. So what does that mean? We've all heard that there is a 43% max back-end ratio. However, there is a temporary exemption of 7 years for USDA, VA, FHA, and Fannie Mae and Freddie Mac loans. And now, mind you, even though with the Fannie Freddie deal, they say that, yeah, there's a 7-year exemption, so you can go beyond the 43% back-end ratio. Does that really mean that investors are going to allow it? I don't know, to be honest. Because while they say, yes, there's a temporary exemption for 7 years, as long as that loan is saleable to Fannie Mae. So what does that mean, saleable? Well, if I get an automated approval, yeah, at 45% back end, yeah, technically I'm safe. But what happens when that loan goes bad? If that loan goes bad and Fannie Mae does a forensic audit on it, they're still going to come back to me and say, yeah, well, we see your automated approval here, but this appraisal doesn't meet our guidelines. Where's our check? And so, while yes, there's a 43% temporary exemption for that, I don't know if, as lenders, if we're going to still go outside of that purview. I mean, shoot, to be honest, if they really wanted to fix it, just fix DU and LP and fix it right there, right? But instead, I think they're going to force us to kind of look like the bad guys to a certain degree. USDA, VA, and FHA could all come out with their own version of a qualified mortgage. FHA, we just saw theirs. Theirs is pretty interesting. While they still have the debt-to-income requirement, they mess around. They move some of their other numbers around. We're trying to get them to come out right now and modify FHA's definition of a qualified mortgage to remove the points and fees cap. But will we get there? We don't know. VA is going to come out with their own definition of a qualified mortgage. They haven't put it out publicly. Off the record, they have said that their qualified mortgage is their guidelines today. So there won't be a 43 back-end max ratio on VA loans. They're still going to go by their residual income test. Now, interestingly enough, though, it's also important to note that VA will also tell you that they're in the middle of restructuring or modifying their residual income calculations. So those are going to be changing. So I don't know that we'll be able to see people that are at a 63 debt-to-income ratio but still fall under the residual income be able to get a VA home loan. I think those are going to change. So the other thing here is that I do have a safe harbor if I originate, as long as my APR is 1.5% less than the APOR, the annual prime offering rate. However, if my APR is 1.5% above the APOR, then I have rebuttable presumption and I lose a lot of my protections under the safe harbor. And rebuttable presumption means exactly as it sounds. While it's presumed that you determine a consumer's ability to repay, the consumer can still come out and rebut that. So, I heard a phone ring. It's a $5 PAC donation for the NAB Political Action Committee. I just wanted to, that reminds me though, if anyone has any questions, just raise your hand and stop me, because I'll move a million miles a second. So, and there's no such thing as a dumb question. The only dumb question is the one you guys didn't ask. So please feel free to just raise your hand at any time. So anyway, so back with the rebuttable presumption, if my APR is above 1.5% of the APOR, then I run the risk of rebuttable presumption. The problem that these guys keep, that they fail to recognize is the APR is a lagging indicator. So it gets published once a week. Go to the website, ffiec.gov, and you'll be able to find it. Why do I say it's problematic? Well, let's just say that they published that 4.2 for the week is the annual prime offering rate. And we have one of those crazy days where the market just tanks and all of a sudden, rates are shoot through the roof. Well, the potential there is that you won't be able to really do a home loan or quote a rate for a borrower until the following Monday, until the rates reset and get republished. So that's going to be problematic right there. And then, of course, we have this little thing on this 3% cap on points and fees. And again, these all start in January 10. So as far as my underwriting guidelines go, has anyone heard of Appendix Q? Appendix Q is what the CFPB deems as underwriting guidelines. Basically what they did, they took the FHA, they cut and pasted the FHA 4155, they toggled it a little bit, they took away my ability to make some business decisions on loans, but with extenuating circumstances, and they took away compensating factors. What they also threw in here are some important things, and well, that might be kind of tough to read, but what you really need to make note of in there is, this is probably my favorite one, income can only be used if it comes from a source that can be verified, stable, and will continue. Income must be reasonably expected to continue for at least the first 3 years of the mortgage. Well, holy cow. Y'all know how hard it is to get human resources to put anything about overtime or bonus income on a verification of income or employment. So how are we going to be able to manage that? I also like to point that out, though, is that when you call your congressman, remind them that congressional appointments are only 2-year terms. So that way when they try to get a mortgage, if they don't help us out with this stuff, they might not be able to get a home loan.